Let's see national income accounting. The definition is methods to measure economic activity in national economy as a whole. So there are three methods. Before seeing the three methods, we will see what is the circular flow of resources in an open economy. So there are firms, there are households. So the firms pay the factor payments, which are labor, your wages, your profit for the organization, interest on the capital, and all this. The factor payments, they go as income to the households. Household in turn save this in the banks or the financial institutions, and the rest of the world, the imports are paid to the rest of the world and the exports are given to the firms, and the banks invest in the firms, government borrows from the banks, and the rest of the world, banks may borrow from the outside, and households and firms pay the taxes, and how government gives transfer payments to households, and government purchases some goods from the firm. So this is the circular economy, circular flow of resources in economy, and a free open economy. All this would be completely balanced. So there are three methods to do the national income accounting, which is expenditure method, which adds the expenditure of the households; income method, which adds the factor payments by the firms; and value added method, which adds the value of final goods and services. So why do national income accounting? For international comparison, to compare standard of living between two countries, to evaluate and formulate the policy, and to provide for optimal resource allocation. So there are certain concepts in national economy. First one is GDP. The definition is total market value of only final goods and services in the given time. In India, it's 1st April to 31st March within a geographic boundary. This is important, regardless of the nationality. So to avoid the double counting, we can follow two methods. First is to count only final goods and services, or count value added at each stage. This way we can avoid double counting. So for example, Jaguar, it is manufactured in UK, but it is owned by Tata. Still, it won't count in GDP. Kia is a Japanese company, but it is manufactured in India. It will be counted in the GDP. Now we have nominal GDP and real GDP. Nominal GDP is at current year prices. Real GDP is at base year prices. So real GDP is the better one because it is inflation adjusted. Why GDP is so popular? Because development always comes from the growth. The example, HDI has per capita income, and it is easy to calculate. It is objective. Example, happiness is subjective. It is easier to compare because very methods don't vary much across the countries. It is well understood by the policymakers. Now coming to GNP, GNP is GDP is where and GNP is who. Therefore, GNP equal to GDP plus net factor income from abroad is how much we get from the abroad minus how much we pay to the abroad. For India, GDP is always greater than GNP because net factor income is always negative. And coming to NDP and NP, first understand the depreciation. All equipment in an economy will be subject to wear and tear. Because of this, certain amount of capital is lost. This is called depreciation. The capital consumption expenditure is part of capital needs to be spent to address this wear and tear. So that is the capital consumption expenditure. Therefore, net investment is what you are doing, the gross investment minus this depreciation. You will get the net investment. And NDP is simply GDP minus depreciation. NP is GNP minus depreciation. Now national income, market price and factor cost. Factor cost is how much is costing to make a product, and market price is how much is it actually selling for. So from the factor cost, if we subtract the subsidy and add the indirect tax, we'll get the market price. For example, if you're manufacturing a tire for 1,000 rupees and you're getting a subsidy of 50 rupees and you're paying a tax of 100 rupees, then your market price would be 1,050. And the national income, national income is NNP at factor cost. Why choose this? These are the reasons. Goods are not printed with MRP in the developing countries especially, and lack of tax uniformity across the states include the foreign nationals. That is why we are choosing the national NNP at factor cost is the formula. Now coming to transfer payments, these are payments done by the government to the individuals for which no economic activity is created. For example, pensions to old age people and widows, and scholarships to students. And nominal exchange rate, this is based on the currency financial markets or forex markets. This is simply the exchange rate, that is $1 is equal to 70 rupees, for example. And this is a real exchange rate, that is the relative price of goods and services between two countries. For example, an egg in India costs 5 rupees, and in say America it costs 10 cents, then 5 rupees is equal to 10 cents. And effective exchange rate is the weighted average of currency against a group of countries. So this is between one country and this is a group of countries. And if we take nominal exchange rate, it will be called NER, and if we take real exchange rate, it is called RER. And PPP globally what basket of goods and services you can purchase with the rupee in comparison to the US dollar. This is the purchasing power parity. Now, how to measure national income? As you've seen, there are three methods: value added, income, and expenditure. Which method to choose? It will be depend on data available and what is the purpose for measuring. GDP in India is measured by CSO, which is Central Statistical Office. So the value added material, you add total value of output produced at each stage, that is GDP at market price. We should count only final goods and services to avoid final to avoid double counting. So we should include those goods and services which are sold in market and which are supplied free also, and also services. But we should not count second hand goods, illegal goods or illegal economy, non-economic goods like air, water, transfer payments, imported imputed rental for house owner. I mean, people who are living in the own house should not count their own rent. And coming to the income method, the factories pay rent for the land, wages to the labor, interest on capital, and profit for the organization. You subtract subsidy and add depreciation, you get the GDP. So we from this we should include income of those for which no goods and services or value addition is there. And in the expenditure method, we should add all spendings on final goods and services. Therefore, households will consume, firms will do investment expenditure, government will do government expenditure, net exports is export minus import. Add all this, we get the GDP from this method. So in India, value added method is used for primary sector, manufacturing sector. Income method is used for service sector. Expenditure method is used for real estate. Now coming to GDP deflator and base year. GDP deflator is nominal GDP by real GDP into 100. Therefore, this measures the inflation. And economists prefer WP and CPI, which are wholesale price index and consumer price index, over GDP deflator, because this is published with 2 months lag, so it will be too late by then. And also it covers the entire economy, whereas these things they cover a fixed basket, so we can measure better with these two. So three bases for selecting base year. Base year is the year from which we calculate the constant prices. So stability, I mean, there should be no sudden changes like lockdown, etc. Data should be available and it should be comparable. Therefore, it should be the most recent one. Now, why it is difficult to measure NI in India? Non-monetization of transactions. For example, barter in villages. Unreported illegal income. For example, 40% of the income is in parallel economy. No data for households and small firms. Example, care work done by the housewives. And no data on growing service sector. At many stages, value added is not reported properly in service sector. So these are the problems. And recent developments, this is asked in the 2021 mains also. So how to measuring growth rate, we have moved from GDP at factor cost at constant price to GDP at market price. So this is a change now. Constant price will be there. And GVA calculation, we have moved from GVA at factor cost to GVA at basic price. So there is a difference between basic price and factor cost, which is to the factor cost you add production tax minus subsidy, you get the basic price. And the GDP, we get it GVA at basic plus product tax minus subsidy. We must note that production tax and product tax are both different. Also, to expand the coverage for corporate sector, we are using MCA 21 database now. For the comprehensive coverage of financial sector, we are including stock brokers, stock exchanges, asset management companies, mutual funds, pension funds, and also all the regulator bodies like SEBI, IRDA, and PFRDA. So there are some debates around GDP, which are growth versus development. Growth is quantitative, development is both quantitative and qualitative. Therefore, it includes quality of life like nutrition, health, etc. And growth does not automatically translate into development. Example, Gulf countries. Now, shortcomings of the GDP, it doesn't cover gender disparity, which will be covered by gender inequality index. Sustainable growth will be covered by green GDP. Economic inequality will be covered by IHDI. Poverty measurement by human poverty index. Intangibles through gross national happiness. Now let's look at the other indices. We have HDI. It is given by UNDP in HDR, and it measures three dimensions and four things, which are standard of living, level of education, longevity. Standard of living is measured by GNA per capita PPP, and Level of education is given two-third and one-third weightage to education attainment of adults in school enrollment. Longevity is through life expectancy at birth. So HDA is you do geometric mean of all three, you get the HDMI. According to 2020 HDA report, India has HDA of 0.645 with a rank of 131. It has increased 50% since 1990. Now coming to gender development index, you calculate the male HDA and female HDA. From these two, you get the gender development index. It compares the male and female HDA. Now coming to inequality index adjusted HDA, you calculate the same thing. Adjust for inequality, you get the IHDA. It is 0.47 for India. Now coming to gender inequality index, we calculate the labor market, empowerment and reproductive health. For this, we calculate the labor force participation rate, education attainments, parliament representation, adolescent fertility, and MMR. So this basically measures the potential loss in human development due to disparity between male and female. Now coming to green GDP, it is GDP minus cost of environmental degradation. So India at 2009 gave the intention that it wants to measure green GDP, but it has not been instituted till. Now coming to gross national happiness, it is done by Bhutan is the main pioneer. So it is based on four pillars which are real per capita income, good governance, environmental pollution, cultural promotion. Coming to human poverty index, it is given by UN again. It is deprivation in longevity, knowledge and standard of living. Longevity, probability of not surviving till 40 at birth, and knowledge through adult literacy, standard of living through access to safe source of water, and underweight children below 5 years. Genuine progress indicator, it is used by US and Canada. It measures sustainability of current income levels. So it uses calculates things like income inequality, cost of crime, environmental degradation, loss of leisure, public infra, volunteering and household work.